morning. So my name is Andrew Romans. I'm a general partner at Rubicon Venture Capital. I'm based in Silicon Valley, and we also have an office in New York City. I'm going to speak briefly about corporate venture capital. I guess we just heard a little bit about that already this morning. And then I'll share a few ideas of how I think CVC, corporate venture capital, can potentially help the Polish ecosystem and other evolving startup ecosystems move a little bit faster. And I'll close talking a little bit about our role in the marketplace and how we work with corporates and startups. So a little bit about my background. I was originally an entrepreneur. I had startups throughout even high school that didn't need, thank God, investors. They just made money. Then I founded a company that was actually quite profitable, and then VCs hunted us down, and I ended up raising over $50 million for that startup. And then I had another startup that was VC-backed with an IPO, and another startup that was VC-backed with an M&A exit, and a couple of failures I don't talk about too much. And then from there, what happens is, if you raise 50 million plus of VC funding yourself, other people that are entrepreneurs will ask you to be introduced to the VCs. And before I knew it, I was introducing a lot of startups to VCs that I knew in my network. And then I got into venture capital banking, which I did out of London for 10 years. So I have a lot of experience with that. And I wrote a first book that got translated into Chinese and Russian. And it actually has been useful because it's helped us raise money for our VC fund from corporations, family offices, conglomerates from around the world, which has given us a really great network to help the startups be more successful. So actually, Huawei from China, I'm originally a telecom entrepreneur, and so I've known Huawei since they were like a $2 billion company. They're getting close to $100 billion in revenue. They asked me to advise them on forming their corporate venture capital unit, their CVC. And so I said, okay, I'll go and interview the top 20 CVCs out there, like Intel Capital, Microsoft, and Qualcomm, and Cisco, and ask them exactly how they do everything. Why do they do it? What are their goals and objectives? And then I decided to write this book. I actually ended up interviewing over 100. And at the beginning, I thought, man, I've met all these guys 1,000 times. I have the chair I sit in when I go to Intel Capital. I don't need to really interview them, but it'll give it more credibility and good for Huawei. But I did learn a lot, and it's a very complicated topic. So the big picture, and I'm working on a third book, which is, I'm obsessed with raising money. I mean, the number one cause of death for a startup is running out of money. You either get it from customers or investors. God help you if you're going to the government. So I'm obsessed with raising money for the startups, and so I'm working on that third book right now. But here's the big picture. When it comes to CVC, corporate venture capital, there's kind of three sides. There's what's in it for the corporate, what's in it for the startup, and what's in it for like the blood-sucking venture capitalists trying to make money like me, and my LPs that are looking purely for financial return. So look, when I had VCs on my board when I was an entrepreneur, I found that they were on too many boards to be effective. They were like on 10 plus boards. They're hardly present before the board meeting, during it, or after. And I came to the conclusion that a good VC is one that doesn't destroy value. And so my goal as a venture capitalist is to add value to the startup and help them as much as possible. If I ever feel like I'm getting in a fight with the CEO too much, then I just back off and let him go away and focus on the other ones. But so our idea of adding value is like a fantasy fund would be that we raise money from every telecom operator on the planet. And let's say that you've got a mobile payment startup that you want to get onto mobile phones, and I got SK Telecom, Huawei, Samsung, and then like Telefonica and all these carriers, and we could put your app onto like 10,000 handsets and then roll it across Africa, and within a year, you've got like huge profitable, great ass-kicking business. and you can IPO that. So the ultimate is you help that startup totally grow through the sales, distribution. I mean, Deutsche Telekom has got customers that are huge, middle, small, retail, everybody. Imagine you can sell through them. Now, at the same time, we all know, if you try to get a deal directly with Huawei in China, that's like suicide, total waste of time. It's probably never going to happen. So part of it is what the startup wants is to grow, to get a customer, to get distribution, like, much more than an individual or family office or an angel can do to help you or a VC. On the corporate side, there's a lot at play here. So I think that in the olden days, the ancient times of the 80s and early 90s, you had to be like Hewlett-Packard or IBM to create innovation, create computers, expensive everything. Now, it used to be 5% of all patents were happening inside of large corporations. Now it's like 30% are happening, or sorry, 95% of all patents were coming from big corporates. Now it's down to 70, meaning 30% is in startup world, and it's probably going to kick into more than 50. It's so cheap and easy to start a startup. If you live in the Valley, Silicon Valley, where I am, there's an investor to fund you at every single stage. You can upset 100 and still find people to invest in your company, and it's cheaper and cheaper and cheaper. Big balance sheets to buy you. There's so much. The graduates from a top university of like Harvard and Stanford do not want to work for the government. They do not want to work for large corporate. They all want to be Mark Zuckerberg, Steve Jobs, Bill Gates. So the real talent is going into startup world, and there's just so much activity there that a large corporation needs to access this external innovation and bring it inside. And it's a must. Like, if you're number one in a declining market, like Ericsson in Sweden, $33 billion company, number one in wireless modulators, that's a declining market. It's going down. They have to change their business or they will die. So they're specifically trying to get into the data center, like hyper data centers for YouTube, Facebook, and that kind of stuff. And they're using corporate venture capital like a weapon to get into it. So they very targetedly invest in other VC funds. They cherry pick out of the portfolios of those VCs. They invest directly in some of these startups. They become a customer or a reseller distributor, and then they acquire. So CVC can juice M&A. If you have a large corporation in Poland or anywhere, and you have a corporate development M&A group, you probably should have a CVC. I recommend taking a look at what's your top line revenue, what's your bottom line EBITDA, what's your R&D budget, what's your IT budget, and make a long-term commitment for like 10 years and start putting money every year off the balance sheet into a legal entity that's separate from the corporation. And number one is start making investments into VC funds and immediately get access to the business intelligence, immediately get access to licensing agreements with the startups. Even your human resources, HR department, if you're communicating well with your CVC, Corporate Venture Capital Unit, you'll start figuring out who to hire at your company. There's conglomerates in Southeast Asia throwing off $4, $5, $6 billion of cash a year, and their M&A department doesn't really know what to do with the money. CVC is this great way of acquiring this business intelligence, learning about this like secondary industrial revolution of dynamic software that can self-learn, heal, AI, ML, whatever buzzword you want to give it. But like Mark Andreessen is correct. Software will eat the world, and it's going to go after every single industry. And even if you think you're a low-tech business, like making tractors or something, you still are a tech company. You've got people with laptops and email and problems and payroll. So I think it's incredibly important to look at your business and even say, if you're a big company, what are the revenue streams of the company? And how recently have you added a new revenue stream? And CVC can help you, diversify. So I think I'm really running over my time. So my advice is, step one, do what Cisco did, do what Qualcomm did. invest in a bunch of VC funds, but only if the VC will share information. You got to get access to every single deal the VC is doing to get that business intelligence, to juice your M&A, to pump up your HR, and there's got to be huge information flow. So the way we structured our company, Rubicon, is that we essentially have become something like a multi-CVC. We raise money from business angels, small checks, family offices, conglomerates, and corporates, and our goal is to add value to the startup and connect the startup to one of our LP investors to help that startup. And then, of course, it brings that information flow into the company. So I think I'm out of time, and I didn't manage that all that great. So anyway, so that's a little bit about us. We do a lot of traveling, and our view is invest in Silicon Valley, San Francisco, Stockholm, Berlin, Paris, London-based startups, and try and connect them and be helpful. And if we're ever not helpful, we shut up and get out of the way. So I don't think we do questions, so that's it. Thank you very much.